Good afternoon and welcome to this week's Advisor Team webinar. As you know, these webinars happen every Thursday at 4:00 p.m. Eastern Standard Time. During these webinars, we try and cover topics that are important to our business owners that help you in the many different ways you operate a business each day, from management to building business credit to getting financing to managing production and accounting, things like that. So thank you for joining us. Today we're talking about a fun topic. Today we're talking about being prepared and the way that business credit works and trends that we're seeing in the business credit world. Simply put, business credit is changing. The business credit world is changing, and so we want to make sure all of our business owners are aware of this and that they're prepared for these changes. So as you know, after we're done with this webinar, it is placed on our YouTube channel and also emailed out to all of our attendees and active customers. So if you couldn't join us today, we hope you check back on the YouTube channel or those emails that are sent out. So let's dive into why you're all here. What you're wondering is, how is business credit changing and how does it affect me? So let's just dive right into it. Business credit is changing, and Tim here, let's put this full screen. He said it better than I could say it on my own. He said most small businesses are unaware of the premium placed on a credit risk assessment when qualifying for business financing. So we are seeing more and more declines based on business credit. We are seeing more and more of an emphasis placed on what is in the business's business credit and so on. So what do I mean by that? We are actually now seeing declines because a client does not have business credit, or because what was in their business credit report wasn't sufficient, or there was negative information in there. So I want to express that again. We are now actually seeing declines based on business credit not being there. And we've seen it in the past where creditors are looking at the business credit, but if it wasn't there, they'd simply rely on a personal guarantee, collateral, revenue, something else that would make them feel comfortable, because it's all about, for lenders, and we've talked about this, it's all about them feeling comfortable that A, you are who you say you are, this is not fraudulent, B, that they're going to get their money back. It's really simple in lending. Really, all you're concerned about is A, am I lending to a fraudulent individual? Which really, as a result, means I'm not going to get my money back. So B is the most important principle, which is, am I going to get my money back? So what do lenders do to satisfy those concerns? Well, they do reviews. They look at resources to help them feel comfortable. How has this customer dealt with credit in the past? Let's look at the personal credit scores. What collateral do I have? Can I easily liquidate it? Are they making money? Is the business failing? These are the things that banks are looking at. It's very logical. And when we put on that lender's cap, when we really start to think like a lender, you'll see how simple it is. So just think about that. The two things that lenders are trying to overcome: is the company fraudulent? So we've got to build a credible company where we can easily verify that the owner and the company are real and set up correctly. We don't want any records conflicting with each other. We don't want them to call the home phone number for the business phone number and so on. So building a credible company so they can verify, that mitigates the first concern. And the second is, are they going to get paid back? Collateral, showing them business credit history, personal credit history, all these things to make them feel comfortable. Okay, so now what we're seeing, whereas before they would check the business credit, if it was there, great. If not, it wasn't as big of an issue. Yes, having it there would give you a better rate, term, increase the amounts and things like that, but we weren't seeing declines just based on the business credit, not even existing. And so this is a switch that we're starting to see. In fact, there are businesses that saw this trend coming And they're developing software for these lenders to use where there's a business credit scoring model built within their underwriting. And Creditera has been a player in that, and some other credit reporting companies. And so I threw some of those general names here at the bottom. But what this means is we're seeing changes, that I am seeing this shift, and we all knew it was coming. We watched as corporate Experian became more and more of a player in this business credit reporting system. I remember as I was started out in this area about 8-9 years ago. Yeah, we looked at the Experian file as a lender, but it didn't have to be there, and it wasn't as clean as it is now. It didn't have as much information, not as many creditors reported. Well, now we see more businesses actually reporting. We see those reports are becoming more and more clear, that the information is more and more accurate. And so now I have a product, or these lenders have a product that they can look to mitigate their risks. And so other companies, software companies, such as Creditera and things like that, that are already involved in providing, credit scoring systems to these banks are integrating the business credit into the underwriting models. And so be prepared and realize that this shift is happening. Okay. And we are, as it says here, we are seeing more declines and challenges based on the lack of business credit, or actually having negative business credit on there. And ignorance is not bliss. Well, it is until until you apply and get a decline or an issue comes up. But I like to remind my business owners, just because you don't know about an issue on your business credit report doesn't mean it doesn't exist. Whereas before, you may have been able to ignore it and it wouldn't really catch up with you, or you'd get random declines, but they didn't actually state business credit on the decline. And did you hear me say that? They didn't actually tell you the reason you were declined was your business credit, whereas more and more they're starting to state it as a reason. That happens. So sometimes customers will come to us and say, it hasn't been a problem in the past. Well, they probably weren't aware that their amounts were a little lower, or they got some declines based on their business credit. So keep that in mind. We're seeing business credit stated more and more as a reason for a decline on applications for business financing. So it's important that you realize what is on your report, just like it's important to monitor your personal credit. Anytime you're about to go get a mortgage, what's the first thing you do? Think about it. What do? You go and pull your personal credit, and you have a little pit in your stomach till it comes up and you've got that beautiful 780 or 820. Same thing with your business credit. You need to monitor it. You need to know what's in there, because this is a change that's happening, and it's going to continue. And I think at an increasing rate, we're seeing where Equifax is becoming more of a player, where more and more entities are reporting to Business Equifax. We are seeing DMB, though they have been through some challenges lately, it's refining them, and they're being pushed more and more to report correctly and to be more of a standard. And that's what it takes for these lenders to look at the business credit as a firm underwriting system. So they need to know, of course, because we're thinking like lenders now, they need to know they're going to get paid back, that the resources they're using to mitigate any concerns or to underwrite the deal, they want to make sure that information is good. And as business credit reporting increases its accuracy and its spectrum is broadened, meaning more people are reporting, more and more information is shown on those credit reports, it's going to become more and more of a staple in the underwriting process. It's a natural progression, and we are in the process of seeing that, and that is developing at an increasing rate. So now you know of these changes that are coming. So are you prepared? It's often too late once it's time to apply. And, being a business owner is hard. Oftentimes you're very much in a reactive state, meaning you are putting out fires throughout the day. And though we don't want to be in that state, and we try not to be, It's something that naturally happens, and it's something we're constantly fighting. So it's often too late once it's time to apply to fix your personal credit or the business credit, because at that point, it takes time for things to be removed. It takes time for things to report and so on. And so I want you to be aware of that issue, that it's too late once it's time to apply. This is something we want to work on before the applications go in. Of course, if it's time to apply right now, we'll do our best to work around it. We've been doing this long enough that we can show you, hey, here are your options. In the meantime, we fix it, we get more options, and so on. That's the blueprint. That's the beauty of the blueprint. This is where you're at right now. This is what needs to be fixed, so you have these options in the future. So we've all been in that situation where we wish we would have been prepared. So part of today's message is these changes are happening at an increasing rate, to the point where I felt it was important to express them on our weekly webinar so that you know what's coming about. And as a member of our program, that's what you're in the program for, is to get these changes, to get these updates, and so on. That's what we're here for. Okay, so this seems simple. What is business credit? We talked about this a little bit, but I like to think of things in a very simple way. Fundamental principles help us understand the bigger picture, right? So what is business credit? And we talked about this, what is credit? This is a standard in underwriting. So essentially, a long time ago, somebody said, I want to see how people handled their credit before I give them credit, right? So maybe a mom and pop shop somewhere decided, I want to offer credit accounts, but I don't feel comfortable unless I see their prior history in dealing with other creditors. And that would be a natural thing. Think about it. If you were a lender, you would ask the same thing. So of course we have personal credit monitoring, and we've got business credit monitoring and reports and so on. And that has developed over time throughout history. So what we're trying to look at is the history of credit performance, utilization, revolving percentages, inquiry. Is there more credit that's going to be added to this report that I don't know about? How much credit have they handled? How much can I offer them? And that is the purpose of business credit. That is what it is. The three most common business credit bureaus are, I was going to say, can you name them in your head? But I've got the answers written on the screen. D&B, Experian, and Equifax. Those are the common reporting agencies for business credit. Experian and Equifax are already in the personal credit world, so their reports look somewhat like personal credit, so it's easier for us to read them. D&B has been around the longest in the business credit world, and their system runs a little bit different than the other two. D&B is more aggressive in their sales tactics and so on. And of course, we dive into that in more detail as we work you through the Business Finance Suite, that software of the Business Credit Building Program. So credibility and your business. We're going to talk about this again. Building business credit also builds your business's credibility. So what do others perceive about your business? How are you controlling their perception, and what factors affect your credibility? If your business is perceived as credible, how does that help your business? So this is that first factor that lenders are looking at. Is this a fraudulent company? Now you're thinking to yourself, that seems silly, but as a prior lender, it's amazing how many applications come across that are actually fraudulent. It's a huge problem. I'm trying to think of the right word to describe it. It's a big problem. In fact, it's the number one thing that lenders rule out when accepting an application. They verify that the business is real and the individual is real. A lot of times that's automated. Things like, checking the address, the phone numbers, are they a cell phone, home phone number, things like that. Just little triggers and tricks that lenders have used that help cut down the number of fraudulent applications that go through. So of course we want the business to be credible. That is why step one is so important. That's why it's important not to rush to the lenders until you're ready. I've said this so many times, but I think it's important to express that as a lender, I was so frustrated about how many applications I would decline based on those factors alone. They didn't have their corporation filed correctly. They weren't even listed as an officer, or their business addresses were wrong. The contact information was wrong. They used partychick@yahoo.com as their email. Those type of things made it so I had to decline because I couldn't verify the business, and I couldn't exactly tell them why they were declined. We don't want them to come back and doctor applications, but I would look at this business owner who really needed the financing. I knew they did. I could see it in their eyes. They just were in a rush and they didn't do their homework. So step one is there for a reason, and you want to keep that in mind. Part of that credibility is your business credit report. Would you feel comfortable bringing your business credit report into a deal, a business deal? Let's say you're selling your business. Would you feel comfortable bringing your report and saying, look at this report. Look at what we have done. Don't take my word for it. Here is another source that shows you who we are and what we do and what we have handled. And building that business credit, they can feel that peace of mind that comes with, hey, this credit has established business credit, which is going to make it easier for us to get financing, to get better terms with our suppliers or distributors, things like that. And that's going to be a large selling point. So if you think about it, building your business credibility not only means making sure you're filed correctly and those things, it also means building your business credit and making sure the information on there is correct. You have to know what's on that report. You have to know the business name, the address. You have to know who's reporting and the amounts. You need to know if there's any public records that are showing. Yes, did you know if you sign a blanket UCC when you're going for financing, it shows on your business credit report. And when it's paid off, they don't always remove them. So you want to make sure that it's clean. A lot of times I'll run into a customer that is surprised with a tax lien. Oh, how frustrating. And so what that means is we applied for financing. We didn't know the tax lien was on there. We got a decline that's vague, that doesn't give us a lot of detail. And then we have to start digging, and pull up that business credit report and have that discussion. You have a tax lien on here, though you paid for it or it's not yours and things like that. It's on there. Now we have to get it off, and we're delayed. We're delayed a month or two. And so that's what we're talking about when it's time to apply. It's often too late to fix the situation. It's something we need to be prepared for. Okay, so the major differences between business and personal, we understand what credit is. We understand why it's important, but it's important to understand the differences because there still are some differences, although I expect as time goes that the differences between business and personal credit will change. I think business credit is going to continue to improve, and so of course we'll stay on top of that. So for business credit, the big thing is it's very black and white. Did you pay on time or did you pay late? Okay, and if you pay on time, you get a good score. If you pay late, your score drops. And so you'll see that the scoring system within business credit is more black and white. With personal credit, yes, it's important if you pay late or on time, but they're looking at revolving percentages and inquiries and things like that. And it plays more within the score. For instance, with DMB, if you have an 80 Paydex, all that means is you have at least 3 trade accounts reporting, 1, 2, 3, at least 3 trade accounts reporting on your DMB report. And it means they were all paid on time. That's all it means. If you get an 85, that means you paid early that month on an invoice or two. But at the end of the month, when it's all done, you revert back to an 80 because a new invoice is generated and the score doesn't increase again until you pay it early. So an 80 is a perfect score. Anything below means there's a payment that was late. That's how simple it is, very black and white. D&B uses other ratings, that calculate other variables, but in general, it's not the same factors that affect personal credit, things like inquiries, revolving percentages. Those other ratings are based on the size of the business and so forth. Okay, major differences between business and personal credit. New accounts, for instance, with Experian, business Experian, they're sensitive to the new accounts. I will get customers that call in a complete panic. My score dropped 50 points. And mind you, in business credit, there's not a lot of wiggle room. Your best score is 100. So my score dropped 50 points because a new account reported on Experian. Yep, that happens. The lender looks at not just the score, were things paid on time or late. So that is the difference between personal and business credit. And I expect that to change and develop. You can see how there may be some flaws in that kind of rating system, but the new accounts on corporate Experian hit hard. New accounts on D&B don't affect the score at all. So there's some differences between the different credit bureaus where we don't see that as much with the personal credit side. Credit scores. Obviously, a personal credit score versus a business credit score are very different. And a personal credit score can be in the 800s. A business credit score in the 80s is perfect. So different scoring models and different scoring models per bureau. The percentages, revolving percentages, this is one of the biggest hurdles business owners have in the personal credit world. And if I could light this up on a sign, I would say, don't use your personal credit cards to fund your business. Or at least do not go above that 30 to 50% range on your personal credit cards, because as soon as it goes past that range, your score drops considerably on the personal credit side, and it basically ties the lender's hands. They're not interested. They're worried you're going to max everything out. So that is typically the most common mistake a small business owner will make, because they're comfortable with personal credit cards. They've got them before. They know how they work. They know how to apply for them. They're easy. They get the offers in the mail. It's comfortable. And so they get these personal credit cards because, you know what, next month I have a huge expenditure. I need to go with something that's comfortable to me. They get the $10,000 personal credit card, max it out to cover payroll. And then all of a sudden we created a new problem, which is your personal debt to income ratio just increased, because now you not only have your personal expenses, but you have the business on your personal credit report. So there's problem number one. Problem number two, your revolving just went to 100% or 90%, which means lenders are no longer interested. So we have to find a way to move it off the personal to the business, wait for it to report as paid down before we can really get any more revolving debt. So revolving percentages are a huge deal on the personal credit side, not as big of a deal on the business side. In fact, really doesn't influence the score. Yes, lenders may look at it, but keep in mind the business reporting is not as clean as it is on the personal side. So that means that maybe Experian and Equifax are better at this, but the dollar amount that's reported may not be the actual balance. D&B rounds up or rounds down and things like that. So lenders don't look at it exactly for the percentage, although I think that will change over time. Okay, monitoring. Monitoring is different. Everybody's heard of a tri-merge account with personal credit. It doesn't work that way with business. You have to do the monitoring with each of them independently. And this will change over time. I'm sure somebody at some point will figure out how to get those three companies to work together and do monitoring. But for right now, keep that in mind. A lot of customers will call in saying, I want to do a tri-merge for my business, and we have to explain that does not exist. There are companies that will do their own scoring model based on the three, but it doesn't give you the specific detail you need to really monitor your credit in a detailed fashion that we recommend. Okay, So why monitor your business credit? I think we talked about it. Why do you want to monitor it? It's becoming more and more important as time goes by. We're seeing a big shift here, and so it's important that you know what is on your business credit, or the lack thereof, if nothing's on there, so that you can improve it. And we don't want to be in a state of denial, or we don't want to ignore it because we're too busy. Because this is something, like I said, it's often too late to fix this problem when it's time to apply. Okay, so we want to be prepared. I already said that. Do you know what's on your business credit report? Ask yourself that question. Do you know what is on your D&B credit report right now? Do you know what's on your corporate Equifax? Do you know what's on your business Experian report? Do you know what's on there? Do you know what your plan is to build it further? What does your business credit look like? Number of accounts. How many do you have on there? Number of new accounts. How many are new? What does that Experian score look like? What bureaus do you have a file with? Are you proud of that business credit? Could you bring that to a meeting and show a supplier, look, we handle our credit well. You can give us the best rate. You can give us the best terms. Is the business information correct? If you move business locations, did you change the business address on your business credit report? Which trade accounts are reporting? Are they all reporting? What's your high trade line? What's the highest balance on there? Keep in mind, lenders, if you've only ever handled $10,000 in credit, they are not going to feel comfortable in giving you $100,000 in credit, right? So keep that in mind. We want to get those high trade lines. How do you do it? Apply for credit, use the account, make that vendor happy, and ask them for an increase. It's a building process. It doesn't happen overnight. You did the same thing on your personal credit. If we all remember, we started out with that $100, $500, maybe even if you were lucky, $1,000 personal credit card. We didn't care back then because we were excited to get that amount, but you're going to go through the same process with your business credit. So what is your high trade line? What amounts do you have reporting? What's your oldest account? Think about it. Put your lender cap on. If you're looking to give somebody money, you want to know, who have they paid in the past, but how long have they done it? If this is their first day at the rodeo, meaning if this is the first credit account they've ever handled and they did a good job this time, that doesn't give me a lot of confidence. I want to see that they have experience under their belt. So how old is the oldest account? Now, this is something that we can't fix. If everything is brand new, it's better to have it than to not, right? But this proves our point that it's often too late when it's time to apply. We need to start building business credit now so those accounts season and get older. It's not going to ruin your chances of approvals if all your accounts are brand new. I want you to remember that. But in 5 years, 3 years, as business credit develops, it might, so why not develop it now? The ownership. Are you listed as the owner on the business credit? Did you buy it from somebody? Are they still listed as the owner? Is it your contact information? So when a lender pulls your D&B report, are they going to see you listed on the D&B report as the management or owner? And if so, that makes the lender's job that much easier. They just look at the app as the guarantor and go, you know what, this is checking out. They're listed as the owner with the Secretary of State, with D&B. I'm feeling more and more comfortable that this application is not fraudulent. Everything is checking out. Are there any sneaky public filings on that business credit report that you aren't aware of? Things that have been paid off, maybe things that you didn't even know were out there. There are times when information is reported on a business credit report that it's not yours, that it's somebody else's, maybe a business name that's similar to yours. This is why it's so important when you apply for financing that you use the correct business name and address. I want to stress out to each of you, and that rhymed. I want to remind each of you that business credit reporting agencies do not report using a DUNS number or the EIN number. They report using the business name. File this away in your memory. They report using the business name and address. So if the business name and addresses are not matching up, the result can be two things. One, it just doesn't get reported. Two, a full new profile is created. Okay. And so then you'll have 5 different reports with corporate Experian and need to merge those. But then with DMB, it won't be reporting at all because the information doesn't match. Now, just because you submit it to the lender correctly does not mean they're reporting it correctly. When you get your statements, make sure the information is correct, that they didn't make any typos, because that is the number one issue. That is the number one hurdle as to why trade accounts aren't reporting. When I have a customer that calls me and says, you know what, Megan, I've been waiting 60 days, nothing is on there. That is the number one question I have. Have we verified? Are we sure the business name and address is correct on all records? All right, let's keep going. Revolving percentages, that is a factor to a point right now, but I believe that will continue to grow. So that's something you want to keep your eye on. And I'm going to express this again. Ask yourself now, do you know what is on your reports? Okay, so how do you, and we're going to just quickly go over this. I expressed, here's the changes. We're seeing a shift. I want you to be prepared. We care about our business owners, and we want to make sure you stop every once in a while from, that drill that you go through each day and ask yourself, am I doing what I need to do right now to prepare to get financing, to make good agreements with my suppliers, and so on. So how do you build your business credit? Well, that's what we do in the Business Finance Suite. We want to build it with trade accounts. Typically, the accounts that report on your business credit reports are trade accounts. Now as we're seeing business credit shift a bit, we are also seeing some loans and lines, specifically credit cards, that are reporting on the business credit reports, especially Experian and Equifax. So in general, you're going to use trade accounts to build your business credit, especially at first when we're putting those building blocks together. But as you have your business credit cards and things like that, some of those may report. Now, keep in mind, you cannot go to the bank and say, will you report my business credit accounts onto my business credit reports? There's not a system to do that. They're not mandated by the government. With personal credit, there's several regulations in place to make sure that the consumer credit report is correct, where lenders have to be held accountable for what they report. It doesn't exist as much on the business credit side, and that's why you have to be in charge. It's kind of the Wild West of credit, if you will, but it's becoming more and more refined. So we typically have to start with trade accounts, and those are the common form that report, but we're also seeing those business credit cards and so on. You want to monitor it. We talked about why that's important. I won't get on the soapbox again there. We want to make sure the business information is correct, as you know. And we talked about the other business credit that we see is reporting. I want to stress this, that it's important to build it. We talked about how building personal credit, most of us started with a $100 credit card or $400 credit card. The same is going to be true with the business. And sometimes that can be hard to swallow. You're a successful business. You've worked really hard. You're not in your teens anymore. And here you are starting all over again with the business credit. And keep in mind that it's normal, that we all have to go through it. And it is a building process in several ways. So that may mean starting with a $400 credit line, $200 credit line. It also means staying in touch with those creditors. So you do your first purchase payment, because it's the payment that reports on your business credit, not the account. And we haven't talked about that, but it's that actual payment that creates the trade line. Well, after that, and you've in it seasons, ask them for an increase. Let's up those high credit limits. So there's different ways that we build the business credit. We talked about how the business finance suite can help, and we'll just review that quickly from a different angle, which is, we've built the software to help you do it and make it simple. And then there's the advisor team to help. So our goal is this, it's three-part. Prepare your foundation. We want to make sure you're credible and ready, that everything checks out, and prevent any silly reasons that an account might be declined. We want to set up the reports correctly and then build the credit. And we do that in phases. So not every lender out there reports, especially bank credit. In general, doesn't report unless it's a credit card. It may report on Equifax or Experian, but we want to make sure we use lenders that actually report, and then we want to identify what the business qualifies for now and what we need to do to qualify for more. For instance, Staples is kind of in the middle of the road. They like to see a little bit of business credit established before they'll approve. So it's not when we want to start out with, but it's likely in the second round. So we've mapped out, hey, here's their underwriting requirements. This is a good time to apply, and so forth. How would you know that otherwise? It would be trial and error. You wouldn't know until you applied and got declined and then tried to squeeze it out of the underwriter. They don't publish that information. Lenders don't tell you exactly what it takes to get approved. And so that's the beauty of the finance suite. That's the beauty of the software. It tells you exactly what you need to do this the right way. And then our friendly advisor team's here to help you too. Here's our contact information. I hope you enjoyed today's webinar. In review, the purpose of this webinar was to tell you business credit is shifting. We're seeing this shift take place at a more rapid pace. In the 8-9 years I've watched this, I can tell it's speeding up. We're actually seeing declines based on the business credit only. We're seeing that creditors are weighing business credit into their underwriting process more fervently. So we want to make sure you're ready, that you know what's on your report, that you're ready for these shifts that are coming, especially as these credit monitoring resources develop software to help these lenders underwrite, including the business credit. We're going to see this increase more and more. Don't get me wrong, lenders are pulling these business credit reports now. They're just not stating it. They haven't been stating it as a decline reason, and now they're incorporating that into their decline reasons. Business credit will always help you improve your terms, get more financing, and so on. So it's always important to build that business credit, and the advisor team is here to help. Our phone number is 800-497-0499. You can also email us at advisor@businessfinancesuite.com. Let's see if we have any questions here. Let's minimize. No questions. Wow, that's just fine. So if you do ever have questions, or if you get questions after this webinar, you can call the advisor team and they'll go through them. If you have any topics you want me to cover or guest speakers you want me to incorporate into these webinars, feel free to let the advisor team know. You can send us an email or give us a call. Thank you so much for the opportunity to work with you in your business. It's a pleasure. We enjoy going through this journey with you, and everybody have a wonderful day.